fit. I sit, but I am not a cat. Okay. Let's get going. Meatball, you doing okay? I think we have 200 likes. Let's get you a treat. How's it going, guys? My name is Andrew. Meatball's getting a treat because he is a good boy. Also because you guys smash that like button ahead of time. Every time you guys do, Meatball gets a treat sent from above. And today, we are going to talk from this perspective about the silver short squeeze. Now, this is fairly new DD from the weekend. They say that it's glaringly obvious to anyone paying attention. The evidence is overwhelming. Take a look for yourself. First off, if you are long GME, this is not a post to tell you to sell GME. Nobody's telling you to sell GME. GME currently is up. Let's see. Last time I checked, it was around 14%, but it is up currently 7%. Still solid. And we are not telling you to do anything. In fact, this is not financial advice in this video. I have to be clear. This is for entertainment purposes only. GME is way overshorted, then brokers allowed this, then the squeeze happens, hedge fund lose tons of money, face insolvency, Citadel gives $3 billion to Melvin Capital, despite the fact that they are supposed to be a neutral market maker, then price keeps surging, then Melvin faces insolvency and will lose Citadel's investment, Citadel is no longer a neutral player, then clearinghouses get leaned on by powerful suits to raise their margin requirements on GME, hint, remember this, then brokers will have to make up the losses of the shorts they allow to occur, then they decided to save their own skin at the expense of their clients and rig the trade. Then instead of going to thousands per share, as IBKR, a CEO, admitted, it would have retailers robbed of billions in gains. We even had a whole congressional hearing last week. I made a ton of compilations as well as videos on that. But now we're going to talk about silver. So you guys are caught up on GME. Happy? Now let's talk about silver very briefly. Well, as briefly as we can. They've organized this post into 4 sections, so feel free to skip around to the parts you are interested in. 1, the silver short squeeze evidence. That's 1. 2, why the hedge funds are pushing silver narrative is BS. 3, the fundamental case for silver and why the shorts deserve to be squeezed. 4, too long didn't read, what to buy silver if you want to go long silver. Go long John Silvers. The potential for the short squeeze, 570% of the float is currently sold short. I even have the SLV ticker symbol going up and down in the left corner. The big thing to remember here is that if enough market participants who are long silver contracts in the futures market begin to demand delivery of their silver, there will be absolutely a melt up in the price because there simply isn't enough supply available. The next 3 trading days are critical, and there is war being waged. The shorts and COMEX are in a fight for their lives and barely hanging on by a thread. Many big name precious metal veterans have bemoaned for years about how the size of paper silver market absolutely dwarfs the amount of silver that could be delivered. Thus, the market is manipulated. The vast majority of futures and options contracts in the silver market have historically been settled via cash, meaning no physical silver is actually delivered when these contracts are set to expire. This is where the talk of 100 to 1 and 250 to 1 paper silver to physical silver ratios come from. But short interest is actually more like 6 to 1 on the COMEX using open interest data through the next 2 big delivery months. Technically, every month is eligible for deliveries, but only months with options interests tend to have any real volume, and that's why they are known as delivery months. March and May are options expiration months, while April is not. If you want to think about it like a stock, the short interest is 573% of the float. That's in bold. This is based on the fact that over the next 3 months, there are futures contracts and options which have the right to take delivery of 847 million ounces of silver. This is compared to only 147 million ounces registered on the COMEX that could fulfill these deliveries. For perspective, GME short interest peaked at around 140% of its float, and that was considered crazy high. It is widely known that if a small but significant share of long silver contract holders took delivery, that there would not be enough silver, as the demand would cascade higher and higher as the prices rise. This would be similar to a bank run scenario. The COMEX is the silver bank, and they have printed too many paper claims on a limited amount of silver. If you guys remember this, bank run analogies, dog treat analogies, that was one of my very first videos on this topic. It means that there is simply not enough for everyone to get what is due, and that is a precarious situation. If there is no actual silver left to be delivered to the holders of the futures contracts, that means that the COMEX would default and settle their contracts in cash. No one wants to get settled in cash if the COMEX had to default. This would mean that right as you want to be able to stay long silver as the price is surging higher, then you will get forced out and paid cash instead of silver and wouldn't benefit from future increases in the price. The traders who want to stay long silver and who see the run occurring would try to take delivery, because if you actually have physical silver in your vault, then it doesn't matter if the COMEX goes down. You still have your actual silver you could sell on the spot market. Most importantly to them, they get to keep participating in the upside. Now the shorts are very much trying to keep the price down at the moment, because their problems get worse as the price rises and more options become in the money. See the chart below with a handy arrow to illustrate where we currently are in terms of March open interest. Look at that arrow. Isn't that pretty? Oh, there you go. Now you can see it. There you go. So as the price rises more and more, the short interest grows as more options on future contracts become in the money, compounding problems for the shorts. This is the silver version of a gamma squeeze, the big event that happened when Robinhood decided to screw over everyone, when GME decided to go moon over $400. This is the silver version. And we're not talking about the second best version. We're talking about silver, an actual precious commodity. The chart below shows the number of ounces that would be eligible for delivery over the next 3 months, given the current open interest data. Most of the open interest comes from futures contracts that aren't dependent on price, but I've made this chart to illustrate how the problems get worse for the shorts due to the options contracts as the price rises. The latest silver price, as this person is writing, is $27. So we see here, yes, you guys can still see here, why would contract holders all of a sudden start to demand delivery when cash settlement has historically been the norm? A couple of reasons. The first reason is arbitrage. Premiums on 1,000-ounce bars have surged to somewhere between $1 and $2 an ounce. This is unheard of from the 1,000-ounce commercial bars, meaning that traders can stand for delivery and then sell in the physical market for immediate profit. When supply has become constrained in previous silver bull markets, these premiums were like 30 cents an ounce. So this is unprecedented. In addition, mints are also interested in arbitrage. They could begin to take delivery to break down 1,000-ounce commercial bars into smaller units, which currently trade at historic premiums of $5 to $8 an ounce. The small unit silver market has experienced greater demand than ever before. The entire stock of small unit silver was sold out at all dealers a few weeks ago. The small amounts they do get in stock are only sold at massive premiums. Imagine taking money, breaking it apart, and now it's worth more. That's the difference between 1,000-ounce bars that are $1 and $2 an ounce, and then breaking it apart, and now they're worth $5 to $8 an ounce. The second reason traders might be taking delivery is that they see massive opportunity presenting themselves right now, and they don't want to be cash settled when the COMEX defaults. They see that the squeeze is possible and that they profit massively by simply taking delivery, sitting on their silver while the squeeze happens and then reselling it at much higher prices. Early rumblings of massively increased delivery volume is already presenting itself in the data. See the chart below showing the past 3 months of deliveries compared with the same time period in previous years. Boom. 2021 entirely different in terms of the amount of ounces delivered in terms of millions. This is actually 2x what 2020 had. Of course, 2020 is a weird year, but that is still 2x of what 2019 has. So it is unprecedented. This chart corresponds to December of the previous year through February of the year that is labeled on the x-axis. So 2016 actually represents December of 2015 through February of 2016. It seems that the silver futures market is suddenly becoming a place where silver actually gets delivered in meaningful quantities. This trend is even more pronounced when you look at it the most recent month of February, which, like April, was not an options expiration month and thus typically has very low volume. Even still, the increased interest in taking delivery of silver from the COMEX is very clear and historic at that. February 2021 deliveries are ongoing and will continue to rise. Look at that. Oh wait, you guys can't look at that. Look at that now. That is insane. February 2021 has had 9.95 million ounces delivered through the 18th, and there are still 1.8 million ounces in open interest. Anyone still sitting in a contract this late in the month wants delivery. So we can only safely assume that February deliveries will end above 11 million and closer to 12 million. This is compared with an average of only 2 million ounces delivered in the previous 3 Februaries, an increase of roughly 422%. March is gearing up to potentially be an earth-shattering month for delivery requests that could send silver soaring. March in the previous 3 years has averaged 26 million ounces delivered. If this year's month of March experienced the same 422% increase in deliveries that occurred in February, this will represent 140 million ounces delivered, enough to completely drain the COMEX registered stocks. If typical contract roll forward behavior persists, we are actually on track to hit around that number. The chart below shows how March is on track to finish the month with between 30 to 40,000 contracts demanding delivery. Let me look at that chart. Wow, look at that chart. So if I can move my face real quick. So the chart below shows that March is on track to finish the month with 30 to 40,000 contracts demanding delivery. We see here that on the very top of the chart we have days of delivery. So on the x-axis, so there's 41 days down to 1 day, and we have on the green line on the bottom of the chart 100% of registered silver in all COMEX warehouses. 30,000 contracts. There are just not enough silver to go around. So March 2021, which has not happened yet, is where we are on track to do so, and the Thursday prelim is there. So it is a very slim margins that we actually get down below at 100% of registered silver line. And this is really something that we notice here: the recent delivery months in July 2020, September 2020, December 2020, and now what March is currently on track to get into. Note that this has one more day of data relative to the chart above. Also, just a little bit more data. The final day to roll contracts forward to not be eligible for March delivery is Wednesday, February 24th. Given these are not normal times in terms of deliveries, it would not surprise me to see the decline for OI in March flatten out and stun the world by finishing with 40,000 contracts waiting delivery. The COMEX has only registered stocks to cover 29,000. And let's say that COMEX survives March and is able to meet all the delivery requests. This is what the May open interest looks like. Can you imagine the COMEX going into May with only 20 to 30 million registered ounces, staring down the barrel of a 450 million ounces of open interest? At this point, the long in May would absolutely stand for delivery and hope they are one of the lucky few that aren't forced to settle in cash. So even if only half or 3/4 of the 147 million available ounces are delivered, the May contract holders will see that the available supply is shrinking fast, creating even more demand for physical delivery because the opportunity is that much more clear for a continued short squeeze. That and the fact that there are longs who really do want the silver for various reasons and would be worried that the COMEX will default and there will be no silver available for delivery at all. This is where critics of the potential for a short squeeze may point out that COMEX starts to run out of silver, they will just find more. It's increasingly not an option, however. The primary stores of 1,000-ounce bars are the MBMA vaults of London and the COMEX. When the COMEX starts experiencing higher demand for gold or silver deliveries, traders start chartering planes to deliver excess metal from the LBMA to the COMEX. This occurred in March and April for gold and silver when physical started trading at premiums and traders began to demand delivery. Boom. So in this chart we see here, ETFs now hold 28,000 tons of London vaulted silver. So this is just a ton of silver being flied from LBMA over to COMEX. The problem with this line of thought is that nearly all of the silver in LBMA is effectively allocated already. The most common silver ETFs, such as SLV, which we're looking at right now, use the LBMA silver vaults to allocate silver to their ETFs, and recent historic inflows to the ETFs has created a situation where the LBMA simply does not have unallocated supply that they will be able to ship to the COMEX. Bullionstar.com recently ran an article showing that 85% of the silver in LBMA is now held by silver ETFs that utilize the LBMA stores. This means that this silver cannot be taken from LBMA to reinforce the registered stocks of the COMEX. Also notice how the last spring-summer in the LBMA inventory, shown in green, dropped. You see, look at it again. So there is not enough silver to go around, and we notice that there is a huge influx from LBMA into COMEX. Is estimated to contain 1 billion ounces of silver, meaning that meaning that 162 million ounces aren't already allocated to ETFs. Not known, though, is how much of this 162 million ounces is owned by wealthy individuals and family offices who already have a claim to it. Indeed, the supply situation at the LBMA is dire enough that the world's largest silver ETF, SLV, had to change its prospectus to mention that they may not be able to find silver to allocate to their ETF in the near future. They made this change on the 3rd, following historic inflows, and didn't make the document public until the 8th for some reason, nor did they announce the change. We have oh my god, we have a lot to talk about, but let's focus. You guys have to understand the situation in the very first part, which is there's not enough silver to go around, and the silver that normally gets flown when the situation occurs from London is decreasing at a rapid rate. So number 2, why we are focusing on why the hedge funds are pushing silver narrative is BS. Several posts have documented the timeline of silver posts on Wall Street Bets and why the narrative of hedge funds pushing silver to hurt GME doesn't really make sense. So it's much more that FOMO is a tactic that hedge funds use. However, there is evidence that this is not currently the case for silver. Besides the fact that many on Wall Street Bets were fans of silver long before the GameStop craze, banks have a massive net short position on silver. At the time the anti-silver post went viral about Citadel having large position on SLV, it comprised only 0.04% of their AUM, and they had 3 times this much, 13.13% of AUM in puts on silver. Here's the proof. Whoa, there it is. So it doesn't make sense for them to try and stop one short squeeze that hurts them by causing a second short squeeze that would also hurt them. They're not sure if hedge fund bots are actually driving this anti-silver propaganda or if it just caught on because people wanted a scapegoat for GME losses. But either way, it seems like silver was in the wrong place at the wrong time. The people investing in silver and the people investing in GME are natural allies. It is a mix of desire for tendies and giving big banks and hedge funds the finger. Why weren't AMC, BlackBerry, Nokia, wheat stocks, and many other popular positions not considered distractions from GME? Wouldn't GME have gone much higher if everyone on Wall Street Bets had stuck to only GME and the other, not these other plays? There was absolutely institutional collusion to prevent GME from getting the infinity squeeze it was set up to get. This is something that I have been saying on this channel. The Interactive Brokers CEO even said on a live TV that the price was headed to infinity if they weren't stepped in to stop the losses. The collusion is simply unrelated to the fact that some of us on Wall Street Bets also like the silver market setup. They totally agree that the media reports of Wall Street Bets moving to silver was somewhat poorly worded, just as the reports of Wall Street Bets moving to wheat stocks were poorly worded. Some people on Wall Street Bets are playing silver, some are playing wheat stocks, and the headlines make it sound like everyone, it's everyone, when it's never true that all of Wall Street Bets is long a single trade. And this is true. We are all a very diverse group of people. The fundamental case for silver and why the squeeze deserves to be squoze. It's really important that we cover this, but mainly in line with the removal of 50% of the monetary base, we experience roughly 50% deflation over the next few decades. So right here we have silver in green, and the price of items in $1 of gold, silver continues to depreciate. Along with this deflation, though, the value of debt also rose. So if you were poor and also indebted, with one stroke of a pen, your money began to become worthless, while at the same time your debt became progressively worth more due to deflation. Yet another reason squeezing silver with banks on the other side of the trade would be true cosmic justice. So we all care about cosmic justice on this channel, and that is one of the ways that we could stick it to the man. In the end, the goal of buying silver would be to make tendies and to end the manipulation of these markets. We need to get to the point where entering into a contract to sell silver means you actually have the physical silver to sell. No more naked shorting and profiteering off the little people. An honest silver market is the ultimate goal here. So, too long didn't read, when this is a very long video now, what to buy. To get the most secure, best value for your dollar in terms of silver, they would prioritize purchase in the following order. Take delivery on the futures market if you're able to. Purchase shares of the PSLV ETF, which will then purchase 1,000-ounce bars. Purchase 1,000-ounce bars at retail if you can find them at reasonable premiums. Purchase smaller units of silver if the premiums come down to 15% or less. There are roughly 1 to 2 billion ounces of small unit silver in the world that don't directly impact the 1,000-ounce bar market, but demand for them does cause premiums to soar, which can then cause mints to purchase 1,000-ounce bars to smelt into smaller pieces. This is also the preferred option for those who are concerned with the total collapse of the fiat monetary system and other doomsday scenarios. Personally, they're just waiting for honest markets to make the tendies, which is why it ranks 4th. 5th, purchase other silver ETFs such as SLV, which is the one that I'm showing right now. Purchasing these will at least theoretically take silver off the LBMA, but recent disclosures from the ETFs are making them seem less trustworthy. And finally, riskier alternatives, purchasing shares of silver miners. Calls on silver miners and even calls on the other silver ETFs are all riskier bets and potentially more profitable short term. This is why likely what many Wall Street bets are going to do. But you guys now know the actual triage in terms of the 6 different options you can buy. To people who say that this looks fishy because of the comment upvote downvote ratio, this is because people who exactly like yourself who auto downvote anything related to silver and really anything not GME. If this post had the same upvote ratio as my original post 3 weeks ago, I'd legitimate have 5 to 10x the upvotes right now. So as of right now, we have made a clear point that silver is not